You open two charts. On the left is gold. On the right is Bitcoin. Both are moving. Both can make you money. Both can take it away. But they don't necessarily attack your psychology in the same way. Bitcoin can tempt you with large moves, constant access, and the feeling that something could happen at any moment. Gold can sit quietly and then suddenly explode when economic news hits. So here's the question. If you traded both with exactly the same strategy and exactly the same risk, which market would be harder on your mind? And more importantly, would the answer depend less on the market and more on the kind of trader you are? Imagine a hypothetical trader named Alex. Alex has a $10,000 account. He risks a maximum of $100 per trade. He trades both gold and Bitcoin. Same account, same risk, same trader. But watch what happens when the market changes. It's Monday morning. Alex opens his gold chart. Price is moving slowly. He sees a possible setup, but nothing is confirmed. So he waits. 10 minutes, 20 minutes, 30 minutes. Nothing. Now something starts happening inside Alex. Not fear, not greed, boredom. He starts zooming into smaller time frames. Suddenly, tiny price movements begin looking important. He sees a candle move up and thinks, maybe this is it. He enters. The setup wasn't really there. He created one because he was tired of waiting. The trade loses $100. And now the psychology changes. Before the trade, Alex was bored. After the trade, Alex is frustrated. He wants another setup. But this time, he's not waiting patiently. He's looking for a way to get his $100 back. Then, economic news hits. Gold moves sharply. Alex watches a large candle appear almost instantly. Now his frustration becomes urgency. He thinks, I knew it was going to move. He jumps in late. Price pulls back. Another loss. Notice the chain. Waiting created boredom. Boredom created a forced trade. The loss created frustration. Then a sudden market move created urgency. And urgency created another bad decision. Gold didn't force Alex to do any of this. But the way the market behaved exposed weaknesses in his decision-making. Gold can create its own psychological pressure because its price can react sharply to things like inflation expectations, currency movements, interest rate expectations, and geopolitical events. And when leverage is involved, even relatively small price movements can have a much larger effect on a trader's account. That creates one kind of psychological environment. Now let's move to Bitcoin. It's Saturday night. Alex isn't planning to trade. He's sitting on the couch. Then he checks Bitcoin on his phone. Price is moving quickly. He opens the chart. Another green candle. Then another. He immediately thinks, something is happening, and here's an important difference. Bitcoin doesn't care that it's Saturday night. The crypto market keeps trading. There isn't necessarily a normal end-of-session signal telling Alex, that's enough, come back tomorrow. So he keeps watching. Price rises again. Now Alex feels something completely different from the boredom he felt with gold. FOMO. He imagines where Bitcoin might be in an hour. He imagines the profit he could miss. And eventually, he enters. But he enters after the move has already started. The trade initially goes in his favor. Alex makes $80. Now he feels confident. He thinks, I read that perfectly. Bitcoin moves again. He enters a second time. This one loses $100. Now Alex isn't simply watching Bitcoin anymore. He's trying to recover. Third trade. Another loss. Fourth trade. Larger position. What started as curiosity on a Saturday night has turned into an emotional trading session he never planned to have. And this is where Bitcoin can create a very different psychological challenge. Bitcoin has historically experienced much larger price swings than gold across many periods. That doesn't automatically mean Bitcoin is psychologically harder. But think about what larger and faster price movements can do to a trader who already struggles with FOMO. A big candle doesn't just represent price movement. It represents imagined opportunity. You don't think, Bitcoin moved? You think, if I had entered there. And that unfinished sentence can be dangerous. because now you're mentally calculating money you never actually had. You imagine the profit. You feel like you missed something. And the next entry becomes less about your strategy and more about avoiding the pain of missing the next move. That's FOMO. But here's where the comparison becomes interesting. Suppose Alex is naturally impatient. Which market might expose him more? Gold might test his ability to wait through quieter periods and remain disciplined around sudden event-driven moves. Bitcoin might test his ability to resist constant access, dramatic moves, and the temptation to chase. Different market, different trigger. Same human brain. And that's why asking, is gold harder than Bitcoin, may actually be the wrong question. The better question is, which market exposes my psychological weakness faster? If you struggle with boredom, one type of market environment can make you manufacture trades. If you struggle with FOMO, another environment can make you chase moves. If you struggle with revenge trading, volatility can make recovering losses feel urgent. If you struggle with overconfidence, a fast winning streak can make you believe you're reading the market better than you really are. And if you struggle with overtrading, constant market access can remove the natural boundary that tells you when to stop. This is also why you shouldn't automatically trade gold and Bitcoin exactly the same way, just because both have candlestick charts. The candles may look familiar. Your emotional reaction to them may not be. Let's go back to Alex. After 1 month, imagine he reviews his journal. He notices something. His worst gold decisions tend to happen after long periods of waiting, or immediately around sudden moves. But his worst Bitcoin decisions tend to happen after he sees price already moving. Gold triggers his impatience. Bitcoin triggers his FOMO. Now he finally understands something important. His biggest problem isn't choosing between gold and Bitcoin. His biggest problem is taking the same mind into 2 different environments without adjusting his behavior. So what can a trader actually do about this? First, identify your market-specific trigger. Don't simply write, bad trade. Write what happened before the bad trade. Were you bored? Did you see a huge candle? Did you miss the original entry? Had you just lost? Had you just won? Were you trading outside your planned hours? After enough trades, patterns may become easier to see. Maybe most of your Bitcoin mistakes happen after chasing. Maybe most of your gold mistakes happen around news. The point isn't to prove that one market is good and the other is bad. The point is to identify which environment changes your behavior. Second, create different boundaries for different markets. If Bitcoin's constant availability makes you overtrade, don't treat the market is open as permission to trade. Create your own session. Maybe you only analyze Bitcoin during predetermined hours. When that window ends, you're finished. The market can continue without you. If sudden gold moves trigger impulsive entries, your boundary might be different. You might define in advance how you'll handle scheduled economic events according to your trading plan, rather than deciding while the candle is exploding on your screen. The principle is the same. Make the decision before the emotion arrives. Third, normalize missing moves. This matters especially when price is moving fast. A market can move without you. Bitcoin can rally while you're sleeping. Gold can spike while you're away from your desk. That doesn't mean you've lost money. You cannot lose a profit you never owned. Missing a move and taking a financial loss are not the same thing. Fourth, keep your risk decisions separate from your excitement level. A dramatic chart can make an opportunity feel more important. But excitement isn't evidence that the setup is better. If your planned risk is $100, the fact that Bitcoin is suddenly moving fast doesn't automatically justify risking $300. And the fact that gold just produced a huge candle doesn't mean you need to chase it. Your emotional intensity shouldn't determine your position size. Now ask yourself something. When you look at Bitcoin moving quickly, do you feel an immediate need to participate? When you watch gold doing nothing, do you start inventing setups because waiting feels uncomfortable? When either market moves without you, does it feel like you've lost something? And after a loss, which market makes you want to click again faster? Your answers may tell you more than asking which market is better, because there is no universal winner here. Bitcoin isn't automatically psychologically harder for everyone. Gold isn't automatically easier. The difficulty depends partly on the interaction between the market's characteristics and your own behavioral weaknesses. A patient trader and an impulsive trader can look at exactly the same chart and experience two completely different psychological challenges. That's the hidden lesson. The market doesn't need to control your emotions. It only needs to create the conditions where your existing habits become harder to ignore. Gold might expose your impatience. Bitcoin might expose your FOMO. Or for you, it might be exactly the opposite. So don't only ask, which market can I trade? Ask, who do I become when I trade this market? Because the hardest market isn't necessarily the one with the biggest candles. It's the one that makes you abandon your process fastest. And there's one psychological difference worth exploring even deeper. Why can watching Bitcoin run without you feel so painful that you enter after the move is already underway, while missing a gold trade may feel completely different? That's where the psychology of FOMO gets really interesting.